So we'll go ahead and just get started because we have such a jam-packed agenda today. Hi, everyone. My name is Nirvana Felix, and I'm the Strategy and Impact Associate with the Women Donors Network. Welcome to the fourth and final workshop in WDN's Impact Investing series. So far in the series, we have tackled cash-based investments, publicly traded portfolios, and private market portfolios. And today we'll be hearing from two experts about venture capital, in addition to alternatives to support BIPOC entrepreneurs. A little bit later today at the close of the workshop, you'll be hearing from me again about what's to come after the end of this series. But until then, I'll go ahead and kick it over to our wonderful host, Maggie Kulyk.
Thank you, Nirvana. And thank you this morning for all of you who are joining. It is a difficult moment we're in historically. I won't talk very much about it, but it seems like it would be inappropriate to just gloss over where we're at. And I just want to say that as someone whose family is ethnically Ukrainian, I'm feeling it today, and welcome your prayers for which I know are coming for all of those folks struggling in that country and around the world. So with that, I do thank you for taking the time out today, given all of that, to join us for this fourth and final session. I'm excited for it. This is about venture, but it really is about venture done differently. The venture capital industry, I'm just going to read a little synopsis that Nirvana wrote that I think is excellent. The venture capital industry is made up mostly of the same people, living the same lives and having the same experiences, making largely the same decisions. And this sameness is creating blind spots. There's a clear gap in who's funded by venture capital. According to Crunchbase data for the first 9 months of 2021, only 3.2% of the founders who receive funding are Black and Latinx. And when you expand that to include Black and Latinx women, that number drops drastically, not surprisingly. But there are experts working to do small business funding differently. In our final session, we're going to be talking with two of them, Jenny Casson and Esther Tricochet, who will join us to discuss what we're doing to create alternatives. So let me begin by introducing Esther. Esther is the Director of Investments at Ideal Investments, the new Kapor spinout that builds upon 30 years of Mitch and Frida Kapor's investments in the venture capital fund asset class. At Ideal, Esther is focused on changing the status quo of venture capital. She runs an internal fund of funds that invests in high-performing, values-aligned VC funds committed to solving real-world problems. Prior to joining the Kapor family of organizations, she spent a decade deploying and managing nearly 150 million, and most recently worked with early-stage startups across edtech, fintech, and healthcare. Esther has a degree in cognitive neuroscience from Rice University and has been named as an Aspen Institute Pahara Next Gen Fellow, is part of the Schusterman Reality Network, and is a Forbes 30 Under 30 alum from 2016. So with that, I welcome you, Esther, and we look forward to hearing from you.
Thanks, Maggie. And looking forward to interacting with the audience later in Q&A. Excited to see so many women who care about this here to chat. And so I'm going to start with just a bit of an overview on the Kapor umbrella to get a better sense for who we are, why we think the way that we do, and what that means for investment. And so high level, we're based here in Silicon Valley, and the Kapor umbrella includes 4 publicly facing entities. So we have a foundation, we have a nonprofit, we have an early stage venture capital fund, and then as Maggie mentioned, Ideal Investments, which I'll say in quotations is a bit of a fund of funds. We invest Mitch and Frida's personal cash and the endowment of the foundation. So a closed inside fund and don't take outside capital. But all of these organizations share in a mission to invest in great talent and to close gaps of inequality. And you can imagine spanning venture capital and nonprofits and a foundation, we do this all in very different ways. At Ideal specifically, we really focus on this idea that diversity and impact can drive financial performance. And I'll dig in a little bit more about why we believe that and what that looks like in our portfolio, but want to start on a bit of a personal note, because we're all here talking about capital allocation, and who we are, our experiences really drive where we allocate capital. And so for myself, I came from very, very humble beginnings. My family was actually homeless several times in early childhood. And so I got to see a lot of inequality very early on in life. And in large part because of that, really committed my own life work to creating more opportunity and to access. And so as Maggie shared, I deployed about $150 million before joining KPOR, all touches on diversity, specifically racial diversity and impact. And so you'll see those themes carry through. We really believe that investing in real world problems and achieving gap closing impact, and I'll share a little bit more about how we define that, can really drive financial returns. And if you're familiar with conventional wisdom in the sector, you know that conventional wisdom says impact equals sub-market rate returns in the VC sector. People are really hesitant to invest in it if they're looking for those strong returns. And we really want to shatter that myth, both within the venture capital fund that we operate, KPOR Capital, and in my work, investing in even more examples of funds that are creating impact in the world, who really value diversity, and for whom those two factors are part of driving financial performance and outcomes. As you probably saw in the pre-reading, 2 years ago, we went public with the performance of KPOR Capital's early stage VC fund. And the synopsis here is the fund focuses exclusively on companies that close gaps of access, opportunities, or outcomes for either lower income populations or for racially diverse populations. You also saw that that fund has performed in the top quartile for funds of its vintage and size. And I want to especially emphasize this is top quartile compared to all VC funds of those characteristics, not just impact funds. And why we went public with performance, which you know is quite rare in the VC sector, is again really wanting to give more evidence to the sector that you can indeed have your cake and eat it too. And I say this because there is a very important trend sweeping family offices globally. It is very prevalent in Europe and is becoming even more prevalent in the US, where there's a generational shift and there are different thoughts around impact investing. So more and more family offices are interested in aligning their investments with their values. And so really anticipate that the amount of cash that are looking for impact-driven investments will really rise significantly in the next decade. And so I mentioned a bit about impact. We also strongly believe that diversity can be a strong part of driving returns. And Maggie shared a bit about the just extreme lack of diversity in the venture capital sector. And so we think about that quite a bit within our own portfolio and look for funds who have significant exposure to diverse founders. And so that is true across our portfolio. And I'll share a few stats over the last few years since I've joined Ideal, which have been some pretty significant years for investments if you followed the 2020 and 2021 market and how much market volume and activity was there. So about 70% of the funds that we've invested in over the last few years have fund managers that are Black or Latino. About 60% have fund managers that are women. And importantly, as a Latino woman, to say this, 40% of those funds have Black or Latino women fund managers, which Maggie mentioned are the most or the least funded in the space. Less than 1% of GPs are Black or Latino women, and less than 1% of funding goes to them. And what we see in our portfolio is continuously building evidence that these factors, when combined with a really strong investment thesis, and for some of our funds, they're specialty funds and might focus on edtech or might focus on healthcare, and for some, they might be more generalists, can really create a very powerful combination. So to illustrate this in real life, I wanted to give a company example. And this is a company that I believe you can also see in the impact report in the pre-reading. We have a company in the Kapor Capital portfolio called Career Karma. And Career Karma was started by 3 men who wanted to break into the tech ecosystem and didn't have a background in tech. And really had to navigate that pathway on their own, and realized there's a huge market opportunity for people who come from non-tech backgrounds to be able to access tech jobs, which in the last decade or so have been huge drivers of wealth creation. And so Career Karma in particular focuses not only on helping people find out what best technical boot camp is right for them, but really has grown quite considerably by helping folks, for example, those in retail who have done retail sales transition to being in tech sales. And so this is a company that has extraordinary impact. One of the co-founders is a Black man. He is very, very conscious of wanting to have very diverse clients within the company. And that company's growth has absolutely exploded. We invested at, I believe, the pre-seed round, and they've just gone on to raise a Series B, I believe about 2 years later. So really significant growth from that company as one example. There are so many more I could share across many sectors, but I'll save that for Q&A. And then wanted to also share, there are also some interesting models that are popping up in venture, in large part because of the lack of access in the VC space. And so I was introduced to Maggie via Julberg Solomon, who of course is a GP in Kulyk Capital, which is part of our portfolio. We are really excited to be on Jewel and team's advisory board, in large part because the fund really has a unique model. It's a bit of a mix between VC and also other forms of finance to allow entrepreneurs to retain more ownership of their own companies. So at the point of exit, they experience more wealth creation. There's a whole system of support behind with a lot of the network that Collab has created to help them grow those businesses, and really see it as a unique way to do venture. Another fund that we are part of, and you can read press releases on both of these to go deeper on the models, or I'm happy to address questions, is a fund based here in the Valley. It's called Base 10 Advancement Initiative. And Base 10 realized while a lot of university endowments were able to invest in VC as an asset class, historically, Black colleges and universities largely did not. And the difference between the largest endowment for an HBCU and the largest endowment for a non-HBCU was a factor of 60x. And so Base 10 Advancement Initiative decided we're actually going to cater to HBCUs and perhaps have some different terms that allow them to be able to participate in this. And a whole range of factors went into this, but also partner with those HBCUs to create pathways for internships for HBCU students to be able to go into careers in tech. And on the other side, they're able to attract founders at the latest stage. So they are investing just pre-IPO and can get access to folks who are really excited to have a mission-driven investor on their cap table. And specifically want to carve out allocation for base 10 because they are so excited about the work that they're doing. These companies are also making a commitment to increase the diversity of their own workforces. And so a really interesting model that blends VC with change around diversity, with access to more career building opportunities for HBCU students. I will pause there and hand it back over to you, Maggie.
I'm excited to just think about what's happening with Base 10. Can you tell us a little bit more about who's behind that initiative? Do you know who the founders are and sort of what? I'm just curious.
Yeah. So there are two founders behind this, Ade and TJ, who were both operators, so had their own company, decided to start a venture capital fund a few years ago, launched Base 10, have done a fund or two around Base 10. They focus a lot on SaaS and came to realize that there's bubbling interest from companies to really deeply think through these issues. Ade is a Black GP, really wanted to focus even more on diversity, and Base 10 has already been far ahead of the curve on this front. And so decided to launch this new model and bring together folks who are really excited to put cash around this and support this as part of creating change in VC, while at the same time realizing the potential for really strong returns.
Well, thank you. It's very interesting. And of course, you mentioned you did a call out to Collab, which is an organization that, I tripped across. And actually, I think I found them because of Jenny, who's coming up next. But well, that'll be a good transition. But before we move off of that, one of the things that was intriguing about Collab Capital was their different, in my perception of, and I will hasten to add that I'm hardly an expert in venture capital. The majority of my own clients do not have the resources or the risk capabilities to invest in what are often very large minimum investment amounts. If you're an individual investor out there looking to find a way to engage in this space, largely, not exclusively, but largely, those minimum numbers of investment are $250,000 to $500,000 into a fund that invests in other funds that are investing in individual businesses. So you can feel the multiple layers, right? There are ways to invest in individual businesses. There are crowdsourcing, there's attempts to democratize so-called this space in terms of investment. But I welcome your thoughts on that, Esther. And of course, we'll talk to Jenny about this, but it's not easy to find your way in if you are even a very high net worth investor. But there's an enormous, and it is, and my perception has been in the past, it's a little less than it was, that it is very much the purview still of institutions, large family offices, institutions like college endowments, even HBCUs were having trouble finding their way in, right? It sounds like this has been set up. So it's interesting. It's interesting to think about the potentiality of that, if there was a way to unleash the capital to smaller investors. The other thing I just want to call out for those of you on the call, if you haven't looked at Kport Capital's 2019 impact report, you really should. It is, first of all, kudos to Kport for going public with their returns. I know that is not the norm, and for really demonstrating the case that diversity is a strength, not a weakness. And there's just feels like there's an enormous upside to this. I'm assuming you guys are seeing that as well. You're continuing to do this, right, Esther?
Absolutely. Absolutely, Maggie. And to your point about access, Yes, it can be difficult to access these funds. And a huge driver behind that is if you think about the fund manager and let's say they're raising a $50 million fund, um, from a management perspective, it's far simpler for them to have 10 $5 million checks
Sure.
than 100 checks of smaller size. But I'd say if you're interested in privately placed funds, which is the sort of traditional structure, your best bet as a high net worth individual looking to be an LP is to get to know first time fund managers who are typically far more open to having high net worth individuals come into their fund. And if you're there for fund one, you believed in them, often they will make space for you in later funds, regardless of what their public minimum is. There's also a different structure of funds that's rather recent based on some legislation. And this allows GPs to essentially crowdsource funds under a certain fund size. And so that's also something that you can take a look at. Often for these types of funds, folks might advertise this on Twitter. Unfortunately, for privately placed funds traditionally, the SEC does not allow one to publicly.
Takes a dim view of that, let's just say, right? Right. Well, that's right. And yeah, that's very helpful, particularly the nod to the first time fund, and of course, there's always this balancing act between taking a risk on someone who has no track record, right? That's I know from talking to investors that even investors who are very committed to the impact space it'll give one pause. But another thing to look for in something like that might be, just a tip, is KPOR, for example, taking a risk on this first time manager. And that information would be theoretically available, correct? I mean, usually a fundraising capital will give you some sense of who else has partnered with them already. Am I right in that?
Yes, and so if you take a look at any of the press releases for Collab Capital and Base 10, they've named some of their LPs, but that's not always the case. And in some cases, LPs want to remain private so that they don't get pitched. So unfortunately, it's a bit of a hazier space than I'd like, but some publicly listed on their website for everyone to see.
Great. Well, I thank you very much. We're going to continue to keep the chat open. For those of you who have questions, some of you on the call may be old hands at this. Some of you may have no idea what we're talking about. All are welcome. So if you have questions about any terminologies we've used or anything, please don't hesitate to pop it in the chat and we'll come back to Esther. And we're going to turn to Jenny now, but we really welcome your questions. There is no dumb question, nor too advanced a question. If it's too advanced, we'll tell you that we have no idea. So, okay. On that note, let me introduce Jenny, who I have known now for, gosh, I don't know, probably, I think we met like 5 years ago now. It's hard to believe it's gone that fast. But Jenny has over 25 years of experience as an attorney and advisor for mission-driven enterprises. She's helped her clients raise millions of dollars from values-aligned investors and has raised $2 million for her own businesses. Jenny co-founded the Force for Good Fund, an impact investment fund managed by Community Ventures, a nonprofit organization that Jenny founded in 2008. Most recently, she co-founded Opportunity Main Street, an impact investment fund that owns a mixed-use building in Baltimore, which serves as a hub for supporting underrepresented entrepreneurs and providing education about community-based investing. Jenny earned her JD from Yale Law School and a master's degree in city and regional planning from the University of California at Berkeley. And her background has led her to develop a different approach. And she's going to tell us a lot more about her model and how it is yet different than the one we just explored. So Jenny, I'll turn it over to you.
Thank you. Hello, everyone. So yeah, my background, it's kind of strange that I ended up doing what I do, because my early career was at a nonprofit organization. I was at an organization called the Unity Council in Oakland, California, doing community development, starting social enterprises. So we started businesses for the purpose of creating jobs. I worked a lot with the small businesses in this community. And I thought I would stay there forever. But after a while, I did get frustrated with the limitations of working in the nonprofit world. And I just started getting really curious about how could I support small businesses? Because I just noticed in that community and in so many of our communities, small businesses, which by the way, small businesses make up, depending on how you define small business, they make up 60 to 80% of our economy in terms of, employment and, production. So they're a huge part of our economy, and yet many of them really struggle. And I just noticed how under-resourced they were. So right around that time this was back in 2006. And I met an attorney who focused on securities law. And I honestly didn't know much about securities law. And here I live in the San Francisco Bay Area, in the heart of Silicon Valley, but I was very out of that loop because I was at this nonprofit. And so I found out that securities law is the law that governs how businesses are allowed to raise money from investors. And I realized that it's quite arcane, it's quite limiting in terms of allowing, regular folks to invest. And because of one of the reasons for the lack of access to capital for small business is these laws, because they're very complicated. Most small businesses don't have lawyers to help them navigate it, don't even know it exists. And so this world of finance, especially, private finance, like Esther was just talking about, is accessible only to very few investors. And so I just got really passionate about getting involved in this space. So I ended up partnering with this lawyer. We co-founded a law firm. Are you seeing me freezing a lot? No, okay, good. It's just on my end. So we co-founded a law firm back in 2006, and we really were just focusing on helping businesses raise funding. And we were focusing on businesses that really were not part of the venture capital ecosystem. So venture capital funds are designed to invest in high growth companies that have the potential to, grow very large, dominate a market, and have some kind of exit event, ideally as quickly as possible, so that the investors can exit with a big multiple within, ideally, a 10-year fund. You're supposed to exit the fund within 10 years, and that's how you make your money, because the businesses in the portfolio have a big liquidity event where they sell or they do an IPO. And 99.9% of businesses in our country, especially those started by women and people of color, are just not a fit for that model. And even those who are a fit for that model may not want to be a part of that model, because it does it really pushes you to grow at almost any cost. And for many, many businesses, they just don't want to do that. They have other goals. So I just want to share a couple of slides. Let's see. Share my screen. All right, where is my slide deck? My God, I have too many things open. I can never find my slides.
It'll show up. Give it a minute.
Wow, I'm really not seeing it here. This is very bizarre. All right.
You may have to paint us a picture with your words.
I just found it. Okay, sorry about that.
Excellent. Okay.
Oh, sorry about that. Okay. Okay. So I was very new to the world of finance. I started learning everything I could. I've now left that business partnership and went off on my own. I no longer needed an older white man to legitimize me after a while. But anyway, so, and I did write a book called Raise Capital on Your Own Terms, How to Fund Your Business Without Selling Your Soul. And so I've spent a lot of time looking into and thinking about business finance. And so one thing that when people think of investors, the picture they usually have in mind is that of a professional investor, which is usually someone who, you know, is either an individual active angel investor or someone who runs a fund, or, you know, an asset manager, like one of these allocators that was referred to before, that would be, you know, be able to invest at the $250,000 minimum. But according to my analysis of the data, if you look at who are investors in our country, 99.7% of investors are not professional investors. They're just regular folks like many of us here today who have money invested somewhere. And so I love focusing on the 100%, not just the professional investors, but everybody, and helping everybody who has money to invest. And unfortunately, that number is going down in our country as well as the wealth divide gets worse and worse, but still more than 50% of people in our country have some money invested. And so I love helping to create that accessibility for everybody to be able to put their money into things that they really are passionate about. And of course, that opens up more potential sources of funding for BIPOC and women-led companies. So a couple things that I've done to work on that is I started a group called Angels of Main Street, which is an organization of, it's angel investors, but it's actually open to people of any level of wealth or income. So that's been going on for a couple of years. We support the Angels of Main Street in learning about direct investing in businesses that they care about. I also co-founded, I actually wrote a letter to the Securities and Exchange Commission, a petition in 2010 that, believe it or not, led to the passage of some major new securities legislation called the Jobs Act, which 4 years later resulted in this new law called regulation crowdfunding that went into effect in 2016, which makes it easier now for regular folks to access investments with very small minimums without having to meet any wealth or income requirements. And then once that happened, I met an amazing woman named Michelle Timish, and together we co-founded an investment crowdfunding platform called Crowdfund Main Street. And we love the term Main Street because what we're trying to convey is we really want to support those businesses, not necessarily just like the mom and pop retail shop or restaurant, but just all those businesses out there that are not on that high growth VC style path, but are just serving their community in one way or another. You know, they may be tech companies, they may be service companies, but they need capital. There's a massive crisis of lack of access to capital for small business. So let's see, next slide. So yeah, we struggle to come up with good names for these things. One thing we say sometimes is we capital instead of VC, we see. So we capital just means your customers, your suppliers, your community, activists that care about the mission of your business are all people that could be potentially investors in a business. And honestly, we capital is the way more, the thing that's been around for longest. You know, a lot of people will call venture capital traditional finance, but actually for millennia, people have been getting together in communities to fund and support ventures. And this is just a map showing different cultures all over the world and what they call these groups that get together to fund things that they care about or support things that they care about. So we capital is traditional business finance. And so I'm just really trying to revive that awareness, because as more finances become more professionalized, and, you know, the venture capital model gets so much attention that a lot of people don't even realize that there's this more traditional way of funding business that's been around forever that we can all participate in. So what does a we capital ecosystem look like? So unlike with the venture capital model, where there's a pretty standard term sheet that is used over and over, which is basically relying on that exit happening for everyone to get paid, I believe it's very important to customize investment terms to each individual business. So one size does not fit all. So we get very, very creative with the investment terms to make sure that however investors are getting paid is consistent with the goals, values, and projections and plans of the business. Instead of that high growth model where there's the exit, the goal is the exit and the sale of the company, healthy, sustainable growth is the goal. The mission of the company is valued as much as financial return, and all stakeholders, not just investors, are valued. So workers, community, environment, and it's accessible for all to participate ideally. So all investors and all entrepreneurs can participate in this ecosystem. So I'll just give a couple quick examples of things I've worked on. Kulyk Ice Cream is a company I worked with a while ago. I wouldn't be surprised if there's someone on here who's heard of them. They're based in Oakland. They make an absolutely delicious dairy-free ice cream. And they offered an investment opportunity, which was a revenue-based debt offering. So you would invest and you would get a percentage of their revenue every year until you reached a certain target return. They actually ended up raising money on our crowdfunding platform. They raised $105,000, and I think they're now raising equity. I haven't been as in touch lately. Another thing, I did do a fund. This was my first fund. I'm now in my second fund. It was a nonprofit fund where we also offered revenue-based debt, and it has a set term. So it's an 8-year term. And we invested in 13 companies, mostly led by women and people of color, very mission-driven companies. And we made it clear that this was not necessarily going to pay super high returns. And we also raised some philanthropic funds to do a loss reserve. So that was a really interesting experience because running a fund is a very, it's a very unique experience. Like, you make all these decisions about your portfolio and you realize later, like, oh my God, we never could have foreseen, like, some of these businesses have completely taken off and been so successful, and other ones have not, that we expected would be. So it's very, very educational to actually run a fund. And that's kind of why we did it. We wanted to run a small fund to kind of just learn the lessons of a fund, because I've been more involved in the direct investing space. So I just want to end with, so as we've worked on all these different projects and helped many, many different entrepreneurs try to be successful with fundraising, and sadly, we have seen some disappointing results. I'll be totally honest with you. Some of our clients have been fairly successful, but some of them have failed in raising money, even with this new tool of investment crowdfunding where anyone can invest. And so we're constantly trying to figure out, like, what does the ecosystem need to really move the needle on who is getting money? And so our newest hypothesis is that because of the adage that change moves at the speed of trust, that there actually is a need, which is funny because we've been so virtual for the last 2 years, but we want to go back to physically being face-to-face, because we believe that is what will actually lead to the trust that needs to be built for a larger number of people to feel comfortable moving their money into investments in small businesses. Because up until now, we're just not seeing the needle move as much as we'd like. And I can share some stats on that later in Q&A if people want to know. But so we started another fund. It's called Opportunity Main Street. And the first thing we're doing before we're starting to raise money to invest in businesses is we're investing in a building, a physical location. We're starting in Baltimore, although we hope to do this in many other locations as well. We found a beautiful, affordable building. I just showed a picture of it. We now own this building, and that building is going to be a hub for supporting entrepreneurs and connecting investors with entrepreneurs. So, and then once that is established and we have our pool of Baltimore-based entrepreneurs, hopefully successfully starting to raise money from their community, then we hope to raise enough money to start doing follow-on investments after they've raised money from their community. So that's our latest effort that we're focusing on. Also, I do want to quickly mention DAFs, donor advised funds. They're very good to be aware of. Many of you probably know, but we did get our very first investment with the help of someone on this call was from a donor advised fund. And that is a wonderful option if you're not quite ready to make an investment, but you'd like to use your charitable funds to play in the space of impact investing and direct investing in small business. That's a great option. So I'll stop there.
That is a great segue. Nice way to land that, Jenny. Yeah, so that's a lot to unpack. Because it's interesting, you're working at this in a sense micro level, right? Where lots of amazing things can happen, and yet it's very hard to leverage. It's very hard to scale, especially in a virtual world, etc. But you are making space for both larger and smaller investors to engage. And I think the Baltimore model is interesting. So correct me if I'm wrong. Part of what that model is doing is investing in the location with the intent that part of how we will see how these businesses do is how the local community responds to them, right? The local community as litmus test for viability of business. Is that
yes,
right?
exactly. So fund managers, a lot of people will ask a fund manager, what is your investment thesis? And so our investment thesis is that if a business successfully does an investment crowdfunding campaign under regulation crowdfunding, they are highly investable for many reasons. Number one, they have to do a fair amount of due diligence, disclosures just to legally be able to do a campaign like that. And second, they have proven that their community supports them and loves them. And third, they're undertaking something that is very challenging. I mean, sticking with that like 2 to 3 months of like constantly getting out there, trying to remind people, hey, have you invested yet? And it's difficult. I did it myself actually back in 2017. So we believe that because of those 3 factors, that is a great way to choose who to invest in. So our thesis is that we will do follow-on investments in businesses that successfully do those campaigns.
It's like a voting mechanism or something, right?
Exactly.
It's like right, drop the ball in the on just to go to the donor advised fund piece. And I know Jenny, you and I've talked for a long time that donor advised fund money can be very critical. It also, we don't want to just rely on donor advised fund money because that implies that these businesses aren't really viable and it's money you've already given away. I mean, there's a whole, to unpack. Exactly. But mechanistically, how that was done was a loan fund. Very generous terms, money coming from a donor advised fund to this entity to help buy the building as a loan fund. And the reason the loan fund idea was easy is it was very easy for the donor advised fund, which of course is the legal entity that signs off on any investments one makes. If you've put money into a donor advised fund, you're allowed to direct where it is granted to, but you're not really the legal owner, of course, anymore of that money. That's the dividing line. That's why it's tax deductible. But some donor advised funds are more flexible than others in terms of the types of things they will allow someone to invest in, and as opposed to just to grant to. So this was an actual investment as a loan fund with the intent that interest would flow back into the donor advised fund. Eventually, that capital ideally will flow back into the donor advised fund, which will then be able to be granted out again, either granted or invested in a different way. So it's a really interesting way to leverage donor advised fund money in this space that is a little bit of this interesting gray area between for-profit and non-profit businesses, because there are just a lot of ways we can move the meter and not all of them are philanthropic. You know, I mean, these two, you know, Jenny and Esther are great examples of people at the forefront of trying to do that. So what we did run into in the donor advised fund space, though, was trying to take a quote unquote equity position as a nonprofit entity, which is what the donor advised fund is, in a for-profit business. You end up with a little bit of weirdness around possible taxation back to the donor advised fund, which is why the lending instrument was the easier way. And I'm saying all this to you because I suspect many of you on the call have donor advised funds and you know, maybe curious about how to do this, or maybe you've done it. And if you've done it and you have an example of taking an equity position, you know, like an ownership position that, you know, we need to know about how you did it, please feel free to pop up and tell us. The question was, is Opportunity Main Street in Baltimore anchored by one or two foundations or individuals? And the question, so the purchase was fully funded by the loan from the donor advised fund? No, it was not fully funded, but Jenny, why don't you speak to the particulars there?
Yeah, I'm not sure I totally understand the first question. You know, Opportunity Main Street is just co-founded by me and my co-founder, Michelle Timish. It's a limited liability company. So there is no foundation involved, although I'll definitely say we've been reaching out to a lot of foundations to see if they want to get involved in some way. We do have a sister nonprofit organization that can accept donations and grants to support the work that's happening at the building. But also we have a dream of doing a guarantee fund. We think that one of the keys to really starting to get folks who aren't super wealthy to dip a toe in investing directly in businesses they love and care about is to have a philanthropic guarantee fund that would say, hey, worst case scenario, if this business fails, we'll make you whole. So that's our dream. We're waiting for that philanthropist to step up and start working on creating that you know, that guarantee fund. But yeah, right now there is no foundation involved other than our sister nonprofit, which is called Community Ventures. And then the purchase was not fully funded by the loan. The loan was a portion of the purchase price, but we also have other investors, you know, investment amounts ranging anywhere from like 25,000 to 100,000, some even a little bit less than that. I'll admit, as someone said earlier, like early managers are willing to go a little lower on the minimum.
Right. Look for your change in your sofa, right?
Yeah, exactly. No, not quite, but yeah, we and you know, we are still raising. We decided to, because of the way the economics of the building and the cash flow works, we actually did decide to offer both an equity and a debt option. So in addition to the DAF loan, which is a very patient, very friendly loan that most people who are investing maybe wouldn't be happy with those terms. So we offer like a friendlier loan, you know, with better interest rates and more, you know, payments happening sooner, and then also an equity investment. So that is, you know, so far we probably have about 12 investors or so.
Mm-hmm. That's great.
Mostly individuals.
Right. And the idea is this is a test case that might be able, if it can get some traction, that might be able to be used. I'm curious. I have a lot of questions that could take this in a whole other direction, and I'm mindful that it's 10 minutes of, and we can take this offline, but let me just ask a sort of really basic question is, like, let's imagine I want to invest as an equity holder in your system. How do you keep track of that? Like, what are the legal, like, how does that, I've always just think, as somebody who was involved only once with setting up a special purpose vehicle for an investment, and the like complexity of that. I'm just wondering how one keeps track. So answer that. And then we've got another question from Peggy Kershak.
Well, it's not that difficult, honestly. You know, we just have to make sure we keep all our documents in place and have reminders of when we're payments are due, and just having a really good bookkeeper and accountant to track everything. It's really not that difficult. With the Force for Good Fund, we actually have about 135 investors. So
Okay.
we're very comfortable with tracking many investors. And, as long as you have good systems set up, it's not that difficult.
So here's the question. This ecosystem seems to bump into issues of participatory grant making and the shift of power from the donor to the community. It still seems very top down, though that may be true of all of this type of investing. What can we do to address the power imbalance? Great question, Peggy.
Yeah, I mean, that really goes back to this whole thing of the democratization of investing. And it is true. I mean, it's just simply true that those who control more money have more power. I was a little bit kind of had rose-colored glasses in 2016 when the new law went into effect, investment crowdfunding passed, regulation crowdfunding. And I was like, oh my God, everything's solved now. Everything is going to get funded now. Everyone who has any money at all to invest, they can all get together and fund the most amazing things. And unfortunately, that hasn't been the case. I mentioned I have some data on that, and this is really sad, but it's mixed, I'll say. And so the data I've seen is that when women and people of color do an investment crowdfunding campaign, their success rate is higher than the average. And that is really exciting because in the venture capital space, it's like ridiculous, the disparity. However, if you dig a little deeper into the data, the amounts they're raising, which is their success, is only 1/3 of the average. So the success is that they're reaching a goal. And by the way, you can lower your goal as you go on. So the average is maybe about $45,000. So they're successfully raising crumbs. So that is really depressing, So yeah, we're trying to figure out like what else is needed, because that alone was not enough. It's huge progress, but we need a lot more. And our latest, we've been cultivating the investor community, and our latest hypothesis is the face-to-face interactions, the relationship building is going to move the needle more.
And Peggy's just offers, interestingly enough, this is also reflected in how women give to political candidates. It's true. And my mind went to reflective democracy and the study that's like when women and people of color are on the ballot, they have as high a probability of winning. The question is getting them on the ballot. And so part of what
last night on the radio,
both of what you are doing, really, that's interesting. Good.
Yeah.
Know that it's an echo of reflective democracy, but it seems to me both what you're doing, Jenny, at one level, and Esther, what you're doing at a different level, are both getting women and people of color in a way on the ballot. You're getting there. There's more and more visibility. But clearly you're playing in different spaces. I mean, you're playing in different levels of potentiality, and yet, I just think about, to your point, Jenny, all the small businesses that make up our economy and how little capital they get. I mean, it makes me want to circle back, and then I'm going to hand this off to Nirvana because I know we're at time, but it makes me think about the beginning of our 4-part series, which goes back to C-Note, where holding cash in community development financial institutions is a way of getting money to these communities too. But I don't know the particulars, how many of those are actually businesses versus things like affordable housing, et cetera. But how to move the capital where it is most needed to create thriving communities. And the thing about, I'm thinking about Collab, Esther, and the investment in Collab and what they're trying to do, which is help, as I understand their mission, beyond being a runner of a fund, they're really trying to help build intergenerational wealth among people of color. It was one of their founders, at least one, is a founder of this fund because she herself was a successful, recipient of capital and had a successful exit as an entrepreneur, and then had capital to reinvest in the community. So it comes full circle.
Maggie, I think that's huge. And that absolutely is explicit for Collab. And above and beyond just looking at diversity on the surface, one thing that we think a lot about at the intersection of building generational wealth, who understands their customer base to be able to build a business for that base. One of our explicit selection criteria at Keyboard Capital, the venture fund, is this idea of lived experiences. So have you lived the problem you are trying to solve? Do you have an unfair advantage in understanding that problem? And therefore will build a product that people who may have similar experiences really connect with. And to go back to the example of Career Karma, the company that I shared, Ruben started this business by getting on Instagram and getting on Facebook Live and talking about his own experiences, how hard it was for him to break into tech, what it meant to be somebody from Atlanta, moving to Silicon Valley, trying to break in from that perspective as well, above and beyond industry. And that authenticity, that realness, that rawness developed a massive following that ended up converting into paid customers. And that level of authenticity, I think, is so incredibly powerful when you consider that at minimum in VC, and Jenny, I'd be curious to hear your thoughts for small businesses. The vast majority of companies themselves that are VC backed are not serving these populations.
Right.
And so there's a huge gap, and otherwise stated, there's a huge opportunity. And so we really see all of this as intertwined.
Excellent. Excellent. Well, I realize we're at time. I want to just say before I hand it over, thank you both so very, very much for being with us. And thank you to all of you who've been on these calls. Some of you who've been here the whole time. Some of you have popped in. But it's heartening to see our membership take such an interest in this. And I just want to thank you all very much for, and thank you both, Esther and Jenny, for the work you're doing in the world. It's aligned with us as WDN, and we want to find ways to support you. So thank you. Nirvana?
Thank you so much for inviting us.
Oh, you're very welcome.
And I saw that you included an upcoming event, Jenny, so I'll make sure that everyone receives the invitation as well. But echoing Maggie, I just wanted to say a huge thank you to our speakers, Jenny and Esther, and of course, a huge thank you to Maggie for really guiding us through this entire learning series. I personally have learned so much from you from this process, so thanks for your leadership and for offering to host this series to begin with. And so everyone, that is the end of WDN's Impact Investing series. I hope that you've learned so much. In terms of next steps, we'll be sending out a recap of all 4 workshops to all of our participants, which will also include the links to the recordings as well as resources from our speakers. You'll also receive a series survey to share any reflections you have about our Impact Investing series. So whether you've attended one workshop or have joined us for the entire series, we'd really love to know your feedback so that we can improve our future programming. So thank you again for participating. I hope that you all take care and look out for a follow-up email coming your way soon. Bye, everyone.
Take care. Thank you.
Everyone.
Bye-bye.